Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome, everybody, to Make Your Money Matter, the show dedicated to helping you create a better relationship with your money. I'm excited about today's show, and here's why. This is a topic we talk about constantly here at One Capital Management with my colleagues, with our advisors, with our staff, and ultimately, and mostly, with our clients. And I love this topic because, again, as I talk to many of my colleagues and many of our advisors, the topic of uncertainties, and not just uncertainties in our life, although there's many, and we'll talk about those, but uncertainties when it comes to our financial future and markets. And specifically around the world, especially now more than ever. I mean, this year we've seen so much political and geopolitical stuff going on. And it's really important that we talk about these uncertainties. And you know, in writing this show and thinking about it, and I don't know why this came to my mind, but Ralph Waldo Emerson once said, "The mind, once stretched by a new idea, never returns to its original dimensions." Let's get into it. Now, before we get started, if you haven't already done so, smash that subscribe button and hit the notification bell. Make sure to never miss an episode of Make Your Money Matter. And as we talk about today, the word randomness comes in. In life, friends, as we all know, holds randomness. Let me give you an example. I grew up in Thousand Oaks, California. My wife, Veronica, grew up in Santa Barbara, California, which is roughly an hour north of me. So with over 300 million Americans walking around this great nation of ours, I would suggest that the probability, even as close as we may have been in location and proximity, the probability my wife and me ever meeting was actually pretty low. Put another way, the odds were very high that we would never meet, that our paths would never cross. In fact, I bet there was more than a 99% probability that we never even knew each other existed. Think about that for a second. Yet we met, fell in love, had two beautiful kids, and got married, all in spite of these probabilities. So in life, we all can see, indeed, it is built with randomness. Random, unpredictable, unforeseen events can defy some of the best probabilities. I mean, just look at what happened a few years ago in 2020 and what happened. Randomness can baffle and deride probabilities of success, turning some worlds upside down, flying in the face of what once seemed so probable. And there's a professor, his name is Menachem Yari. He's a distinguished economic scholar who was taught at Stanford and Yale. And one of the pillars of his economic philosophy that I studied one time is that when making plans for the future, this is obviously paraphrased, when making plans for the future, a person must account for uncertainty. And as I've learned in nearly 20 years in the financial advisory business, the only way to combat uncertainty and randomness is through proper planning, active management, and discipline. So, from the Great Recession or even the Great Depression to today's health crisis, if you will, we're reminded that there are things that are just out of our control. Uncertain times come without an invitation. Times that try men's souls usually appear without advance notice. So today, we're gonna be talking about how you can better prepare for these uncertain times so they don't destroy your finances, and what you can do to build your house on the rock, as it's stated in Matthew, when the storm comes, as it still will be standing. So people without a stable financial plan really tend to, in my experience, jump on every moment in the stock market. I've said this before and I'll say it again. It's not about timing the market, it's about time in the market. All right, it's very important. And I've noticed one common denominator when it comes to those with a plan, maybe with also an advisor, they tend to actually stick to that plan and get less emotional when it comes to investing. That's probably hit list number one when it comes to managing volatility, managing uncertainties, or us economic nerds call it as black swan events, these unforeseen, unpredictable events that happens. Because if you're one of those listening right now and watching right now and going through, stocks and kind of emotionally investing, you'll buy those stocks because everyone's buying them. It's actually called herd mentality. It's studied in economics. You're buying it because everyone's buying it and then selling them because everyone is selling. So think about that for a second, right? Warren Buffett actually calls it the fear-greed cycle. It's a cycle that we get stuck on. Fear, greed, fear, greed, just keeps going. And if you've heard anything about Warren Buffett, he's got a lot of quotes around this, and people without a financial plan that I've noticed don't really know how to react to uncertainties. So here's what's going on in the market in general, okay? This is kind of a breakdown, if you will, between what's happening, what they say, and then what happens next. Let me give you an example, right? The market is at an all-time high. That's what's happening. Let's say end of 2021, all of 2021 for the most part, right? If you think about that year, for example, what's happening is the market is at an all-time high. What they're saying is stocks are overvalued. A crash is coming, has to happen, has to come, right? And what happens next? The market typically goes up. It's kind of how it works, right? Now let's take the inverse of that. What's happening? The market has dropped, more like the early part of 2022. What they're saying is this is the big one. The worst is yet to come. What happens next? The market tends to go up. Just look at history. So I want to show you a graph here on the page. And this is actually a graph that we did here at One Capital Management, and we called it bumps in the road. Now, what you're seeing here on the screen is the S&P 500, the intra-year declines versus calendar year returns. Now, what I want to point out here that's important as it relates to that little breakdown I just did around what's happening, what they're saying, and what happens next. What happens next is usually the same thing as we see over history. It tends to go up. So we want to make sure when we talk about uncertainties and randomness is to help control the emotional investing around that. That's something that a plan does. That's something that a good advisor will do. That's something that we want to share here, obviously, on the Make Your Money Matter show. And it's important. And as you're looking at this graph again here, as always with capital markets, the long road has some bumps. I mean, if the market just went up all the time, you wouldn't be watching this show. You wouldn't be needing to watch Bloomberg or CNBC or Fox Business or anything you're watching right now because the market just go up. You wouldn't need anything, right? Makes sense, okay? But the long road will have some bumps. And over the last 42 years, as you can see here, the annual return in US stocks was positive despite intra-year declines averaging 14%. So let's think about that for a second. So you look at this graph, for example, and let's just take the past few years, right? You see those top marks there in the past year of 2021, right? Up 27%, year prior, 16%, year prior, 29%. Now look below that line for a second. You'll notice that last year, as an example, there was an intra-year decline of around 5% at one point throughout the year. The year prior, we all know what this was, 2020, right? The whole year cycle was up 16%, but there was an intra-year decline of about 34%. Right now, as you're watching this, we are in the springtime, if you will, of 2022, and we've had a volatile 2022, as we all know it. We obviously had inflation coming out from last year, supply chain issues. Obviously, we had a Russia-Ukraine invasion, which obviously sparked a whole bunch of interest across the globe as it relates to oil and gas prices and the like. But if you look at this, back to the graph for a second, 33 positive years over the last 42 years. The average intra-year decline was 14%, but the average annualized return over the last 42 years, all of it, including the intra-year declines, was up 6.5%. Now, if you watched last week's show, we talked about investor behavior a little bit. And we're going to talk a lot about that on the show. And we talked about the Dahlbar report, how we as investors tend to shoot ourselves in the foot when it comes to our management of our assets. And what the study had just shown for the year ending 2021 was largely around the S&P's index returns over 30 years versus the average investor's return. And there was like a 6% delta difference between that. So we don't have a market problem when it comes to uncertainties or unforeseen events that are happening. We have a behavioral investment problem that I think really matters. And if you break this down in that graph that we just showed, we're not showing it anymore, obviously, but that graph that we show, just think about the last few years. And I wrote a few down here that I thought were kind of interesting, okay? And just going back 10 years as an example. 2021, we had US Capitol attack. 2020, COVID-19, right? 2019, impeachment inquiry. 2018, 2 government shutdowns, remember that? 2017, the Harvey, Irma, Maria storm that were happening, pretty interesting. 2016, US election, pretty volatile. 2015, Brexit, come on. That seems like forever ago, but it feels like also yesterday. Brexit, 2015. 2014, we had an Ebola scare. 2013, a government shutdown again. Well, actually, it was the first one. 2012, fiscal cliff. In 2011, we had the European debt crisis. That's just 10 years. So think about that for a second. Every inversion of the yield curve creates some fresh anxiety. There's always some anxiety around there, and they're tossed around like all the time because they don't have a strong foundation. So as much as it sounds like I'm beating a dead horse on this whole thing, the idea is that not having, the crowd mentality is really important. Now, unfortunately, some people, which actually includes 72% of Americans, and I'll allude to that in a second, actually fall into this camp. So I want to show something to you guys that we actually derived from our investment committee. And it's around the comment I made earlier around, it's not about timing the market, it's about time in the market. And as you can see here, this is actually a study we did between January 2000 and December of 2020, okay? There was 5,288 trading days in there. I know you super care about this right now, but it's important. Hear me out. Now you can see there's a couple bar graphs in front of you, right? There's a total period, missed 1 best day, missed 5 best days, missed 15 best days, and then we missed 25 best days. What this is trying to illustrate, what I want to share here, is about staying invested, why it matters. It's not the whole set it and forget it. I'm not asking you to just trust someone, drink their Kool-Aid, and then lose your password, okay? It's really about understanding active management and rebalancing. But you can see here that 7 of the best 10 days occurred within 2 weeks of the worst 10 days. Think about that for a second. So the second worst day of 2020, as an example, March 12th, was followed by the second best day of 2020. So staying invested and understanding and not letting your emotions get the best of you matters. And as you can see here, it matters on a rate of return. That bar on the left for total period, 4.54%. And this is obviously based on a performance number of $100,000 invested starting January of 2020. Versus if we missed 25 of the best days because we were trying to time the market, we'd actually be negative 4.17%. So embracing wealth planning and financial planning is of utmost importance, as mundane as it may seem.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
And some interesting statistics I want to share with you, not to get you all numbers-based today, but it's a good conceptual idea. There was a report done in May of 2019 called the Modern Wealth Survey by Charles Schwab. And the report actually showed why financial planning really is the golden truth here, all right? People with plans, per this report, are 70% more likely to pay things like their bills and save every month compared to those without a plan. To me, I sum that up, being a financial advisor for nearly 20 years, discipline. Now, another point of reference here was people with a financial plan are 68% more likely to have an emergency fund than people without a plan. Again, discipline. Now, those with a financial plan are 74%, again, based on this study, more likely to automate a portion of their income into savings, investing. And lastly, I want to share this. The note I want to bring home from this Charles Schwab study was that really what financial planners exhibit is better investing habits. And here's why. The survey shows 85% of planners who invest regularly, planners being you, the client, having a plan, who invest regularly, rebalance their portfolio, and 75% consider risk tolerance when investing. So really the takeaway here, if you think about it, is people with written financial plans have a greater feeling of financial stability. 63% financial, emotional stability compared to those without a plan. So when you have a rock solid financial plan, you're not always swayed by every movement of the stock market or left at rock bottom by every recession, if you will. And what I want to take away here in discussing around uncertainties and randomness is understanding market timing and being careful to make sure you have a disciplined approach to your investing and ultimately to your financial plan. Obviously, having discipline and discernment, which really comes from advocacy, in my opinion, has a lot to do with the success ultimately with your goals and objectives as it relates to your money. Now, as rudimentary as some of this might be, it does show that while we cannot control the events and circumstances in our life, the random, unforeseen events, we can create and execute plans that help us stand firm in adverse situations, and especially in uncertain times when they arise, which they will. Dave Ramsey actually once said, which I thought was really hilarious, around rainy day funds. They said, well, why are you so negative about that? Well, or why are you so down on it? Well, I'm positive it's going to rain someday. It's pretty simple, right? So I think it's really important when you think about that concept around how we look at money, how we look at uncertain times, and making sure we keep our emotions in check, because as you can see from some of the stats we showed today, it matters. I mean, it really does. I've said this before, but if you just invested in the S&P 500 30 years ago and lost your username and password, right, you'd be most likely, based on these studies, a lot more probable of better return than you would if you were actually managing it. And I don't mean everybody, but in general terms, than actually managing, because you're more emotional about your money. So when it comes to uncertain times, especially when it comes to our investments, understanding and having a plan and sticking to it and having counsel or an advisor to help you with that really does make a difference. And I can't help but think, and it was funny, my wife and I were having dinner the other night, and it was kind of this conversation with friends around getting older. And for many of you watching right now, you know, when you're not in your 20s anymore, maybe you are, but eventually life starts creeping up on you. And the things that we think that we want to grow, like our investments or our savings, right, really is not what ends up growing, right? We want our bank account to grow. It says no. We want our lawn to grow. It says no. We want our hair to grow. It says no. Muscles to grow? Nope. Stomach? I got you. So getting older is not all that great sometimes, but understanding our functionality around investing, you know, it helps to understand and keep it in check so that it doesn't run away from you, right? And I think that's important as we look at the topic around uncertainty and randomness. And I bring that up obviously because I think it's topical right now, given what we've seen in the start of this year. And as you can see from the studies, understanding and keeping in check with not market timing, but time in the market really makes a difference. Now, I want to shift over to the segment in our show where we go through some questions. And if you have any questions that you'd like answered by me, you can put them in the comments section below. You can also go to our About section on our page and send a direct email to me. And or if you want to meet with us one-on-one together to go through a conversation or a question you might have in private, happy to do so. And one of the questions I wanted to touch on today that was asked, specifically around this topic, was around automation. So there was a comment and a question I was having with a client a couple weeks ago that I thought about this as I was writing the show around automating and some of these robo-advisors and systematizing our investments. Does that help for volatility, or does it help for staying disciplined to a plan? Without getting into the weeds of some of the data around, you know, the volatility control, things like that, I will say this. The concept of the question that was asked and how I want to answer this is really around, back to that word again, discipline. And the word I actually want to use is dollar cost averaging, or I should say the vernacular or the term I want to use, dollar cost averaging. So what is that? Right now, the majority of Americans are actually dollar cost averaging. They just don't realize they're doing it. You're doing it every 2 weeks or every month from your paycheck if you're contributing to a 401k plan. It's the systematic contribution of fresh capital to a portfolio. Now, if you think about that for a second, you are basically systematizing 24 or 26 times a year, depending on your payroll, okay, new fresh capital coming into your account. So if you think throughout the year, as I mentioned earlier about intra-year declines, you can think you can get a really good concept around the idea of buying at different prices. What's the one thing we all know about investing? Buy low, sell high. Like, I think everyone at the base level understands that. So why wouldn't we want to do investments over time periodically on a consistent, disciplined basis to be able to buy low and sell high? Because we can't time it. We don't know what's going to happen tomorrow, let alone next week or next month. So when we focus on systematizing your contributions, the term I would use and how I would answer that is not necessarily robo-advisors or things like that. I'm not saying that's right or wrong at this point. What I am saying, though, is that getting a plan in place to continue your dollar cost averaging approach, again, staying disciplined, even during uncertain times, which is obviously a great question to ask today with regards to this show around markets randomness and uncertainties. And I'm struck by a quote actually on this subject. And when I was answering this question, that reminded me, it was actually written by Benjamin Graham. And I actually have that book behind me, Security Analysis. It's kind of like the Bible for all investors, right? And the quote he said one time was, "The investor's chief problem and even his worst enemy is likely to be himself." Understanding keeping pace with a disciplined approach towards your investing matters, especially when it comes to uncertain times. And if you don't like that, how about Charlie Munger? famous Berkshire Hathaway, mimicking the herd invites regression to the mean. Don't be one of the herd. Follow your plan, stick to it, find that advisor, find that counsel, build that plan to make sure uncertain times don't affect you. And if all that I've said on today's show doesn't add up, I'm going to leave you with this, because I think this might be a better example as I'm thinking through today's show. It's kind of the double standard when it comes to market volatility, uncertainties, things like that. Home prices drop. What do we think? Typically as an investor, we're like, that's great. I'm going to buy a house. Stock prices drop. What do we think? Oh, this is terrible. Think about that for a second, right? We are good when a house drops, we want to buy, but when a stock drops, we should be having the same mentality. Volatility can be a good friend if you know what you're looking at. I'll get off my soapbox. Again, if you have a question or comment you'd like me to read here, leave it in the comment section or email us in the About page on our channel. And before we go, if you found anything helpful today and want to learn more about us, our advisors, our team here at One Capital Management, you can go to our website. It's up there on the screen. Look, we want to help. Listen, there's no pressure here. We don't treat people like a number. In fact, we value relationships. It's the lifeblood of what we do. So click, call, or text us today. And if you're not following us on social media, you should be. We're sharing great information on all of our social media platforms. We're looking forward to seeing you there. So thank you for spending part of your day with us. And remember, as I often say, if you love this show or like the show even, share with someone you like. And if you don't like the show, share with someone you don't like. But until next week, always remember, make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.